Hi there, good morning. My name is Victor Alui, Head of Investment Strategy at Sankore Global Investments, and this is your weekly financial markets roundup. We start off in the US markets, where the market rebounded on Friday after the Dow posted its worst session in more than a year just the day before. The Dow added 0.8% on Friday. The S&P was up 1.1%, while the Nasdaq gained 1.2%. Now, despite the bounce that we saw on Friday, all three indices were down for the week. The Dow lost 2.27%, which was its worst weekly performance this year. The S&P slid 0.95%, while the Nasdaq lost 0.8%. It was quite an eventful week, really, with Fed speakers essentially echoing the higher for longer sentiments, and even the Minneapolis Fed President Neil Kashkari, floated the idea of a rate hike. As far as he was concerned, the economy is looking really strong, and the possibility of a rate hike was certainly not off the table. So this essentially, roiled markets all of last week. Also, in consonance with the comments by other Fed speakers highlighting the fact that interest rates could likely stay longer could stay higher for much longer than a lot of people had envisaged. So this created quite some turmoil in the market. We, however, saw a rebound on Friday on the back of the jobs reports, which would typically have been a boon for the markets. But again, I think markets just decided to look on the bright side of that report, on the fact that this was showing that the economy remained really resilient, and that it would basically contribute very strongly even to corporate earnings as well. Now, the jobs report that came out on Friday showed that the economy created 303,000 jobs against an estimate of 200,000 jobs. Again, wage growth and wage growth basically stayed flat, month on month, while labor participation also grew. Unemployment rate dropped from 3.9% to 3.8%. Also, in the course of the week, we saw some geopolitical tension in the Middle East. The bombing or the missile attack on the Iranian embassy in Damascus essentially heightened tensions there. We saw crude oil prices also rising to their highest points in about 5 months on the back of these tensions. Iran has promised a retaliation, the proportion of which that we have not seen yet. So remains to be seen how Iran does retaliate. But this is creating some, tension in the Middle East, and basically creating some tailwind for crude oil prices. Going into this week, really, the key data points we'll be looking out for will be the CPI number that is slated to be released on Wednesday. Market is expecting a 0.3% increase month on month, and a 3.5% year-on-year increase. Really remains to be seen where this number prints, because the CPI number will prove to be very crucial in determining market direction, at least in the near to the medium term. But over in Europe, it's a different story with inflation. Inflation slowed to 2.4% in March against a 2.6% expectation. This has basically boosted expectations again that the ECB will start cutting rates in the summer, in June. The ECB has its next meeting on the 11th of April, where we are expecting to see further guidance as to its interest rate path. But with the slowdown in inflation that we've seen so far in the Eurozone, we think that the ECB really is on course to start cutting rates from its meeting in June. Also, we saw journals come out for the Eurozone, where unemployment stood at 6.5%, down from the previous reading of 6.6%. So clearly, the sentiment economically in Europe seems to be improving, and it is likely that the ECB would cut even faster than the Fed is likely to do. Over in Nigeria, the CBN has essentially maintained its very aggressive monetary policy stance. It floated an OMO auction last week to mop up excess liquidity. We had some CR and swap maturity refunds last week, which boosted system liquidity to over 500 billion. The DMO offered OMO auction last week, 500 billion, which was oversubscribed by about 695 billion, and saw the long end essentially closing at about 21.12%. This stop rate seems to be sort of signaling a ceiling, if you will, in terms of those TBU rates. This is essentially where TBU rates, particularly the long end, have closed at the last 2 auctions thereabout. So it really remains to be seen if this truly is the ceiling, particularly if you look at what's happening with FX. We've been hovering around that 1-2 mark. Is the CBN comfortable here? Is this where they want to stay? We are seeing inflation over 30%. Are we going to start seeing some disinflation on the back of the tight monetary policy that we've seen enacted over the last 2 weeks really remains, to be seen. But on average, Treasury bill rates expanded by 21 basis points last week. The bond market was essentially the same thing. However, it was largely colored by the release of the Q2 auction calendar, and we saw demand wane really at the secondary market once that auction was released. The expectation is that stock rates are likely to close higher at the auction, and that created some bearish sentiments in the bond markets. This week is essentially a holiday short where we would have basically 3 days. The CPI number coming from the US will prove very crucial in determining what happens for the remainder of the week in global markets. While for our local markets, the outcome of the PNA auction that is scheduled to hold midweek, which we now think will happen on Thursday, would also be very crucial in determining what happens to interest rates and sentiment generally in the fixed income market. That's pretty much it from us. We do hope that you have a very, very productive week. Thank you very much.